Broken Pie Chart Podcast, episode 76. I'm your host, Derek Moore. This week, going to be talking about this disconnect between, or is there a disconnect, should I say, getting some questions on this, between the economy and the stock market. And I've been getting this question a lot lately, and I find it interesting because the stock market is a forward-looking sort of animal, right? It looks at the future and it discounts down to the present what it believes is going to happen in the future. The economy actually, and unfortunately we get, and I'll talk about this, Atlanta Fed does a GDP Now forecast, but a lot of times the economy can be a little trailing and just the way that things are reported. And so one of the questions is how did the market go back up, and the economy is going to post really, really bad numbers in Q2. At least that's what everybody expects. So Q2, of course, being, April, May, June, right? So just kind of ended. We're in July now. And it's interesting to kind of look back. Obviously the market pulled back quite a bit February into March and has then rallied. It hasn't made a new all-time high, although I believe the NASDAQ has made a new all-time high. But to put it into perspective, and where, this economic recession, if you want to call that, I think we can call it that, right? Even though technically we don't have the Q2 numbers yet. Well, first let's just start. If we look at GDP, so gross domestic product, and the number that came in for Q1 was negative 5%. Now, that is an annualized number. And what do I mean by that? If we say it's down, 5%, you've got to divide that by 4. So for the quarter, it was negative 1.25%. You basically multiply it by 4 and you get your annualized amount, right? So GDP is always given on an annualized basis. What happens is Q2, actually, you get, so January, February, March, you get the first estimate in April. You get the second estimate in May. And then you get the final estimate for Q1 in June. And we actually won't get the first estimate for Q2 until July, right? July. And then the second estimate is August. And the final estimate, whatever the final reading from Q2 GDP, you actually don't get that until September. So it's pretty evident right now, and by all accounts, that Q2, which of course was during the lockdowns, is not going to be great, right? The Atlanta Fed has something called the GDP nowcast model or forecast model. I think they call it the nowcast model. Basically, what they do is, as they don't editorialize, from what I can tell, and all they do is they say, as we get bits and pieces of data, we add it and we come up with sort of they call it a GDP Now, right? So the last numbers that we had, and I think these were updated, will next be updated July 16th. This is July 9th. And if you're listening to this and, it's not July, it's like 2 years from now, just know Atlanta GDP Now is a forecasting, not necessarily a forecast, it's a nowcasting as they call it. And so what they're nowcasting, the numbers are, it's actually right around negative 35%. So remember, you got to divide by 4 because that's an annualized amount, right? So which would be a little bit under 9%, drawdown. So, by the way, it actually got as bad as almost down something like 53%. That was in June. And there's an important caveat with this. Again, all they do is they look at, as numbers come in, they sort of add it to the pile. And they start to piece the puzzle together. And so this can actually change, late in the game. This can actually move around a lot. It can be quite volatile. When this started, I think it was only down negative 12% on an annualized basis. But regardless, the Q2 is not going to be great. You'll start to get the official numbers. You're not going to get them, until some point in this month, probably within the next 10 days or so. You're not going to get the final number until September. And so the back of the napkin, are we in a recession, is you have 2 consecutive quarters of negative GDP growth. The reality is there's the NBER, which is a National Bureau of Economic Research. They actually decide when recessions start and when they end. And often they don't make the firm or final declaration on those until after the fact. So that's why a lot of people look at, just the 2 consecutive quarters. So as we look at this, and I'll link to the Federal Reserve Bank of Atlanta, the GDP Now forecast, and then you can actually come in there and you can look at the sub-contribution charts, and that's just a fancy way for saying, like right now they have consumer spending down, over close to negative 23%. Non-residential fixed investment almost down 4%. Government spending down about 1.5%. So you can actually see the contribution charts. You can see the release dates. You can see the release dates for the data. But I bring this up because, a lot of people are like, how is it that the stock market can dislocate and, we're going to have massive, bad numbers in Q2, which I just explained, right? Of course, if we get any sort of recovery, you could see some of the best percentage gains, that we've seen if there's a recovery. JP Morgan has something, they call it Guide to the Markets. I'll link to this as well. And they put into perspective this recession. So they're actually calling it a recession, right? And the way they measure these is they have them set up as decline in real GDP. So real GDP is just saying after you take out inflation or deflation, what was the actual change in the final, the value of all the final goods, right, in theory. And so they have the number right now at about negative 12.8%. So current recession, negative 12.8% decline in real GDP. Where does that compare? Well, a lot of people were saying, this might be as bad as the Great Depression. Not quite. The Great Depression was actually negative 26.7% decline in real GDP. And, that's quite a bit more. I know that's more than double where it is right now. To put that into perspective too, during the financial crisis, there was only a 4% decline in real GDP. And this one is more on par with a post-World War II demobilization that JP Morgan points out, and that was a negative 12.7 decline in real GDP. So this is a good point to make because a lot of people say, well, how can the market, how could it have come off its lows? We don't know if that was in fact the bottom. A lot of people believe it is. Some people say it's not. That's what makes a market, right? But remember, in 2008, 2009, when we hit the lows in 2009, peak to trough, we were down something like 55%. And then, of course, 2008, it was down 37%. It fell more through the first quarter of 2009. But think about that. During the financial crisis, negative 4% decline in real GDP, but the market actually went down about 55%. So here, it's kind of flipped a little bit, at least where we are right now. If you put a stake in the ground, you say, where are we right now compared to how far down we went? There on an annualized basis, well, we'll just use the JP Morgan number, negative, 12.8%. Again, because they come out with the quarterlies and then those are annualized. So, if you see negative 40%, it's actually down 10% for the quarter. But when you look at where the market's been, the market declined at one point minus 34%. as of the close Thursday, I think this is on an intra-year basis, the market was only down about minus 2% year to date. So the market, at least so far, seems to have bottomed before the economy has. And I say that as a caveat. We don't know what's going to happen. But the market is looking forward. And that's one of the things the market is trying to do, is trying to look at earnings, look at future expectations. Any number of things can change. But it is interesting when you look at the market and you look at the economy. Both of them don't have to necessarily move in tandem. And I think for a lot of people, they look at that and they say, well, that doesn't really make any sense to me, right? But remember, 2008, recession, I think they said according to JP Morgan's numbers, minus 4%. The market got down, something like 50%. Before I talk about just earnings and expectations on earnings and what that, at what point do you get back to the level we were at in 2019? It is worth noting that this rally, and we've seen it with the NASDAQ, we've seen it with the S&P, it's really being led by some of the really big companies, your Amazons, your Microsoft, Apples, Googles, right? They're a pretty big part of the index. And I think I saw something that on an equal weighted basis, meaning, the S&P 500 is a collection of, I should have looked this up before I went on air, but it's something like, 505, 506 companies. Google has two different classes of stocks. But anyway, what happens is the weight in the index, so the larger the stock is, like Microsoft has a market cap of 1.5 trillion. Apple is probably right close there. They, on a percentage basis, they make up a greater percent of that index. On the NASDAQ, it's even more pronounced. I think, Apple's something like 14% of that index. So those stocks, big stocks like that, they're driving a lot of the performance. The equal weight, meaning you equally weight, stock number 500 and however many there are in the S&P right now, stock 505 and stock number 1, they each have the same weighting in the index. And when you look at it that way, it actually is underperforming the weighted index. I think it's something like 20% right now. I'd have to double check on that. But that's one of the things that people point to. And that's the nice thing about an index. When you have an index, it's a living, breathing thing. And that if, let's say, right now, financials and companies like Exxon, so energy and financials are making up a lower percentage of the index than they had. But let's say tech falls and financials and energy all of a sudden go on a run. Well, they would sort of have more weighting and they would be responsible for more of the levels of the index. So that's the nice thing about using an index is you're not trying to pick, you're just letting, and it has this momentum function in it then, that the bigger companies that are running, you sort of own more of those, right? So this brings us to the idea of earnings. And if I go to, I just did a quick search. I'll link to one of the, I think this is Yardini research. And I just did a quick search and it came up on Google. And they have their own forecast in there, but they also have the consensus. So analysts' consensus estimates are, they take all the analysts and they sort of, average those out, come to a consensus. So in 2019, the earnings on the S&P 500 were about $163. Okay, what does that mean? Well, remember, if you take all of the companies in the S&P 500 and you aggregate, so you're not weighting these, you just aggregate all of the net income, and you just aggregate it all together, right? It was $163 for the year. And then you can break it down by quarters. Coming into this year, I think the estimates were something like $176 to $179 per share. So obviously you were looking at growth. The estimates now are, well, you have one actual, and that was Q1, which is a little bit over $33, right? Because you have quarterlies. And then, so the estimate now is basically, $124.81. Let's call it 125. That's a consensus estimate. And then there are other folks, either below that or above that, right? So what happens is, obviously that is a decline in earnings. If you actually get that number, remember, that's just an estimate. We don't really know what the actual earnings are going to be. And just kind of as an aside, and by the way, if you did get that decline, that would be, about a 23% decline in earnings from the prior year. Okay. So remember though, and that the market, if you do fundamental analysis, right, if that's something that you do, and you're looking at earnings and you're looking at cash flows, what you're doing is you're looking at the current year, you have some estimates about the next couple of years, and then you assume, maybe at the rate of economic growth, that companies or the companies in the index will grow at sort of a steady rate. They call it a terminal rate, right? So, and then interest rates come into that. The lower the interest rates, the more that, future earnings are worth, because you don't have to discount them down by quite as much. But the consensus analyst for 2021 says earnings will go to about 163.32. So a little bit more slightly than 2019. And so based upon the consensus estimates right now, just estimates, don't know if they're going to come true, you would say 2021 will recover and get back to 2019 levels. You won't necessarily have growth by a lot over 2019. But, and then 2022, it looks like the estimates are something like 186.30. So, that would be growth. If you actually got that number, if that turns out to be true, and you got that year over year, what you'd actually have is you would have, obviously declining by 23% this year. You would have an increase, but the increase would just bring you back to 2019 levels in 2021. And then you'd have something like a 14% increase from 21 to 22. So that's a long way of saying that a lot of this, and part of the problem right now with when you watch CNBC and they say, well, the market is super expensive because it's trading at 21 times, full year 2020 earnings. Yeah, that's correct. But what that doesn't necessarily take into account is the following year. And by the way, when they say that, basically all they're doing is they're taking the index value and they're dividing it by the amount of earnings. So let's say if the index was, 3,100, right? Just make it easy. And your earnings were 163. You would be trading at 19 times, forward earnings, right? And so what they're saying right now, if you're 3,100 and, you do have, let's say we use 125, you're trading at something like close to 25 times forward, 4 quarters, right? So I bring this up because a lot of times, especially recently, I think there's been this thought that the market has to go down equal to whatever the economy goes down, and it should go up whatever the economy goes up. The reality is that markets go up and down. It's always the classic supply and demand. And I think what happened in February and then early March, you did have a lot of panic. You had a lot of panic selling, and prices can get dislocated. And what that means is prices can go down further maybe than they should, and prices can go up further than maybe they should, right? And I think there was a study by Fidelity. I'll try and pull it up here. I think they said clients over 65 took money out of equities. And I'll try and find that. But I think one of the things they said was that somebody had passed this to me. If I find it, I'll put it in the show notes. But that clients over 65 at Fidelity, I think they took out or they reduced, they either reduced it in total or they reduced it much more significantly to bonds. But they took money out of stocks when you saw the drawdown, which is kind of interesting. So anyway, I bring this stuff up. Hopefully this is helpful. There's a couple things here. Number one is Atlanta GDP Now. I will link to that, of course. That's a way you can, as every bit of granular data comes in, they update that. They don't editorialize it. It's going to be very volatile. It can change. And, but that's one of the ways you can get, because actually they're giving you Q2 data right now. And then I believe the first week of August, they'll start giving you Q3 data. Now, they'll only have a few data points. Like, for example, they might only have one economic indicator come out, like housing starts, and then they got to sort of, do a nowcast on that. I'll also link to, of course, the quarterly change of GDP, the JP Morgan on the markets. That's a really good resource. I mean, it's pages and pages long. It's a PDF. I think you have to register, give them your email. But they put a lot of good information out there, more information than you could ever need. So I'll link to that as well. And I'll link to the where I got the earnings forecast. Remember, though, of course, earnings forecasts can change. And the other thing I'll just tell you, too, is anecdotally, and I've mentioned, Professor Jeremy Siegel. He wrote the book Stocks for the Long Run. I'll link to that. One of the points he made was in 2008, earnings declined quite a bit year over year, and they declined much more than the market declined. I believe that's the case, but certainly more than the economy declined. And the point he made was that when you have these periods where, you're in a recession, markets, and I remember him talking about this, a lot of times companies might write off things, meaning maybe they purchased some intellectual property or a trademark or a business, and that's the time to sort of write things off, write it down, take a charge on your earnings. And so sometimes you see that where companies are cleansing their balance sheets a bit. And, he made that point of when you looked at earnings in 2008, 2009, but 2007 to 2008, I believe the decline was quite a bit there. So something to keep in mind. As far as what happens going forward, remember, the market is a discounting mechanism, and it will look at what it believes the future will be. It will look at the information that it knows, and then supply and demand. It's institutions, to a lesser extent individuals, buying and selling. And that's why you see markets overreact one way or another, because you've got that sort of emotional element in there. So anyway, I'll link to all that stuff. Hopefully that was helpful in thinking about the economy through the GDP lens and thinking about the market and what it's trying to figure out right now. And I don't envy analysts who actually do this and are trying to put numbers on companies and markets, because a lot of companies, I think, have withdrawn their guidance. And also, there's a lot of, we sort of don't know what we don't know right now. But anyway, hopefully this is helpful. We'll be back next week with another episode. Of course, you can review it on iTunes, give us 5 stars, send us a note, let us know this was a question that somebody had. I turned into an episode. And then, of course, please share this episode with somebody. If you paste the episode, link it, on your favorite site that you discuss economics or invest in, and I would appreciate that. All right, everyone, we'll be back next week.